Hey friends, welcome to the Singapore Market Digest for Thursday, May 26, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. Singapore's economy has kicked off 2025 with impressive momentum, showing stronger than expected growth in the first quarter. The Ministry of Trade and Industry recently reported that our GDP grew by 3.9% in Q1 compared to the same period last year. That's better than the 3.6% economists predicted and even surpasses the government's advance estimate of 3.8%. This growth was primarily driven by manufacturing and export activity as businesses rushed to ship goods before new U.S. tariffs took effect. On a quarter-to-quarter basis, our GDP contracted slightly by 0.6%, but that's still better than the expected 1% drop. Looking at the broader context, this growth comes amid challenging global conditions. Trade tensions between major economies continue to create uncertainty, but Singapore has shown remarkable resilience. The manufacturing sector, particularly electronics and biomedical production, has been a key driver of this growth. Service sectors, especially financial services and information technology, have also contributed significantly to our economic performance. Turning to individual companies, Singtel has made quite the comeback. The telecommunications giant reported a net profit of $2.8 billion for its second half ended March, a dramatic turnaround from the $1.3 billion loss posted in the same period last year. This translates to earnings per share of about 17 cents, compared to a previous loss of 8 cents per share. The market responded positively, with Singtel shares rising 1.1% to $3.85 yesterday. Singtel's recovery reflects their successful digital transformation strategy and strong performance across their regional operations. Their Australian subsidiary Optus has shown improved results after addressing service issues from previous years. Meanwhile, their digital services division has expanded rapidly, capitalizing on growing demand for cloud computing, cybersecurity, and digital marketing solutions across the Asia-Pacific region. In a significant move, Singtel has authorized its first share buyback program worth up to $2 billion. This demonstrates management's confidence in the company's financial position and commitment to returning value to shareholders. The telecom giant is also restructuring by incorporating new wholly owned subsidiaries in Singapore, Singtel International Digital Services and IDS Cloud, signaling their continued focus on high-growth digital services. Industry analysts are generally optimistic about Singtel's prospects for the remainder of 2025, citing their strong position in 5G infrastructure across Southeast Asia and growing enterprise solutions business. With digital transformation accelerating across industries, Singtel appears well-positioned to capitalize on these trends. Moving to the real estate sector, CapitaLand Ascott Trust, or CLAS, recently announced the pricing of $260 million in perpetual securities at a 4.2% interest rate. These securities are expected to be issued around May 28th as part of this $2 billion multi-currency debt issuance program established in 2009. OCBC is managing this issuance, and CLAS plans to use the proceeds to redeem $250 million in fixed-rate perpetual securities issued by DBS Trustee back in 2015. This refinancing move suggests prudent debt management by CLAS, potentially taking advantage of the current interest rate environment. Despite this announcement, CLAS units ended flat yesterday at $86. The hospitality-focused REIT has been benefiting from the strong recovery in global travel, with their portfolio of serviced residences and hotels across Asia, Europe, and Australia showing improved occupancy rates in recent quarters. The broader Singapore REIT sector has been delivering mixed results so far this year. While hospitality REITs like CLAS have performed reasonably well, office and retail REITs continue to face challenges from changing work patterns and consumer shopping behaviors. Industrial and logistics REITs remain market favorites due to strong demand for warehouse and distribution facilities driven by e-commerce growth. Looking at other major stocks on the SGX, DBS Group Holdings has maintained its position as Southeast Asia's largest bank by market capitalization. The bank recently reported strong quarterly earnings, driven by higher net interest income and fee-based services. Their digital banking initiatives continue to attract new customers across the region, and their wealth management division has shown robust growth despite market volatility. In the industrial sector, Keppel Corporation has been making significant progress on its Vision 2030 strategic transformation. The company has further reduced its exposure to the offshore and marine sector while expanding its sustainable infrastructure and urban solutions businesses. Their recent renewable energy projects across the region have attracted positive attention from ESG-focused investors. The technology sector on the SGX has shown some of the strongest growth this year. Companies like C Limited have benefited from continued digital adoption across Southeast Asia, with their e-commerce platform Shopee and digital financial services gaining market share. The expansion of Singapore's tech ecosystem, supported by government initiatives to position the city-state as a regional innovation hub, has created a favorable environment for technology listings and investments. Regarding market outlook for the coming months, several factors deserve attention. Global inflation concerns have moderated since last year, but central banks, including the Monetary Authority of Singapore, remain vigilant. The MAS's most recent policy statement indicated a cautiously optimistic outlook while acknowledging downside risks from geopolitical tensions and supply chain disruptions. Singapore's export-dependent economy continues to be sensitive to developments in major trading partners. Recent economic data from China shows signs of stabilization in their manufacturing sector, which could benefit Singapore's export industries. Meanwhile, the U.S. economy has shown resilience despite higher interest rates, supporting demand for Singapore's exports and services. Environmental sustainability has become an increasingly important factor for investors on the SGX. The exchange's enhanced sustainability reporting requirements, which came into full effect earlier this year, have improved the quality and comparability of ESG disclosures. Companies with strong sustainability practices have generally attracted premium valuations, reflecting growing investor preference for responsible business practices. That's the scoop for today's Singapore Market Digest. Remember to do your own research before making any investment decisions. While Singtel's return to profitability and Class's debt management moves are positive signs, it's always important to consider how these developments fit into your own investment strategy. This is Iggy from the Investing Iguana, signing off. See you next time for more insights on the Singapore market.